Let's start with earnings. The end of the quarter is only a few days away, and already the expectations are high. Bob Pisani explains.
The end of the first quarter is just around the corner. The bulls are hoping a strong earnings season may provide a market stabilizer for what is likely to be a very rocky debate over tax reform and infrastructure spending. First quarter earnings are now expected to rise more than 10% from the same period last year. That would be the best quarterly showing in nearly 6 years. Now, the early signs indicate the earnings might even be a little bit better than that. The first 12 companies that have reported first quarter numbers, Micron and Nike, Oracle and R, they've reported average earnings gains of about 12%. Those 12 have also seen the best quarterly gains since the second quarter of 2014. And it's not just earnings. Revenues are expected to jump more than 7%. That will be the best growth we've had in about 5 years. So what's the key to these rising numbers? Well, the two biggest sectors in the S&P 500 are technology and financials. They're set to deliver earnings gains of about 15% apiece. That's huge. These are the two biggest sectors. Second, energy earnings. After nearly 2 years of declines, you know what's going on there. They've turned positive as well. So is there any risk? Well, yeah, the big one is to oil. Big oil's ability to pull off big gains in 2017. It seems problematic. Oil's in the mid-40s, and many of the earnings estimates for oil companies were developed with oil closer to $60 a barrel. But the average price for oil this quarter was $52, and that might be enough to pull off expectations for earnings for the oil companies this quarter. The bottom line is the markets are about to enter a seasonally weak couple of weeks just prior to the April 18th tax deadlines, and any good news on earnings will be welcomed by traders. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.